According to Credit Suisse, so the answer might lie in the 3-month, 10-year yield spread, and it is signaling no recession for years to come. Joining us now is the author of that note, Jonathan Golub from Credit Suisse. Jonathan, this is based on kind of historical patterns of how things shift when things uninvert. But aren't we in uncharted territory now about the nature of the Fed's influence over markets and what the economy is doing?
Yeah, I mean, let's start with what the premise here is, which is that the yield curve is the most valuable, the most useful indicator of when your next recession is going to be. And the yield curve has been inverted now for several months, which is making a lot of pundits believe that we're on the precipice of recession. The opportunity here, though, is that if you look at the futures curve, you can buy and sell treasury bills, treasury bonds, whatever, for delivery a year from now, 2 years from now, 3 years from now. So you actually have a market-based prediction of when the yield curve is going to return to a non-inverted position. And so, or putting it differently, how long the yield curve is going to stay inverted. And it normally stays inverted for a year, maybe 6 months, maybe 18 months. And right now, the market is predicting that the yield curve is going to stay inverted until the beginning of 2026, which is just extraordinary. So if you're looking at that, the only logical assumption is that the next recession isn't going to start until at least sometime in 2025.
But isn't there also stagflation risk here? I mean, you say inflation is going to continue to run hot, but growth is going to be muted at best. I mean, that doesn't mean a recession far off doesn't mean an all clear.
Right. So we kind of coined the term stagflation light. If you look back at the 1970s, what did stagflation mean? It meant that you would double digits inflation and double digits unemployment. I mean, right now, what we're looking at probably over the next year or two is inflation that's going to be 3.5% to 4%, and the unemployment rate that's going to be 3 to 4%, which is super low, and economic growth, which is probably going to be 1%, which is low but not recessionary. It's kind of like an uninspiring economy, annoying inflation, but nothing that's dramatic, weak economic growth, but nothing that looks like a recession, not really great for stocks, not a bad environment to be putting your money in T-bills or something like that. And that's kind of what's most likely as a backdrop.
All right. I want to get into that in a little more detail. But first, just to go back to the 2025 recession call and the fact that you are looking to the bond futures market and kind of working your way backward to make that recession call. It raises the question, how accurate is the bond futures market, however many years, 3 years out?
Yeah, it's a great question. I mean, whether you're using the futures for oil to predict oil prices or whether you're using consensus estimates from analysts to predict corporate profits, there's always a question on whether any of these as signals, how good are they? Directionally, this should be really good. So do I know whether or not the recession is going to begin in early 25 or late 24 or mid 26? That's really, really hard. But is the market telling me that the Fed is going to raise rates a couple more times and then they're going to stop, and they're going to stop for a really long time? The market's telling you that the Fed is going to tolerate inflation above their 2% level, and that the economy is going to be weak. And all of those directionally seem pretty smack on. The exact time and the exact numbers, to your point, impossible to predict.